Hey everyone, welcome back to the REI Marketing Secrets podcast. Today on the show, we have Zach Lemaster. Zach, for our audience out there who's just learning about yourself and your company for the very first time, do you mind just going into a little bit about your background and what your company does?
Yeah, absolutely. And thanks so much for having me on, Trevor. I'm very excited to be here. So our company, Rent to Retirement, is the nation's leading turnkey investment company. Essentially, what we do is identify the best markets throughout the country where we see opportunity and make turnkey properties available to our investors where they can actually physically own properties across the nation and some of the best markets where we're handling everything for them. This is, management, assisting them with financing, building a strategy to expand their portfolio. So that's essentially what our company does. Just to give you a little background on myself. So, like many of us that find ourselves full-time real estate investors, I didn't start here. My background is in healthcare. My wife and I are both optometrists by education. We went to school in Oregon. That's where we met. I was on Air Force scholarship for school. So joined the Air Force as a captain for 7 years. That's where I started investing in real estate. First house was a house hack duplex, lived in half, rented out the other half. Fell in love with real estate, very tangible. And from there, I just kept buying rental real estate, and that was locally where we started out because that's what I knew and felt comfortable with. But there was a pivotal moment in that that really changed the trajectory of our lives in general, but certainly our business and our investing trajectory. And that's when we decided to learn how to invest out of state, Trevor. And this was very powerful because we were successful investors locally. But once we made the U.S. our entire landscape and learned how to identify some markets that had more affordability as far as purchase price and entry point, better returns, better cash flow, better appreciation, and just better fit our goals. We were able to expand our portfolio across the country, and that took many years to do that. That wasn't easy. We made a lot of mistakes, but we built a system and process around that where we were able to eventually retire ourselves from our professional career paths in healthcare, and that caught a lot of people's attention. Where we had friends and family and colleagues that were coming to us saying, "Hey, we see what you're doing in real estate. That seems very interesting. Can you help us? Right? Can we invest with you? Can you show us how to invest? Can you know give you money? Whatever the case is." I mean, they were looking for resources to invest. Maybe their local market was too expensive, or they needed some hand holding. Whatever the case is, and that was the birthplace of Rent to Retirement. So fast forward 10 years later, where we're at now. We work nationwide. We really focus on like the Midwest and Southeast, especially Southeast, and build to rent new construction, single family, small multifamily, where we can offer investors the option to buy those properties and make smart cash flow decisions, where they're actually 100% owner of the property, where we handle everything for them. And, the rest is history. So.
What was that process like going out and investing out of state? Because I think to myself, where one, when I was living in Massachusetts, the numbers just didn't make sense. They just weren't working out, just how expensive the properties were. But now I'm in New York, and that's where I live now. And the numbers do make sense. I could go out and I could buy, I don't know, I think I saw like a $250,000 property, make a cash flow. It would hit the 1% rule. So $2,500, $3,000 a month. But I don't like New York just given the blue state and given, the thing, they're like trying to pass a new law that's going to hurt landlords even more. So I wouldn't want to invest here. Just, I think it's too much red tape. So for me, I would want to go out and I would want to invest, like you mentioned, the states like the Midwest, maybe the Southwest, maybe Southeast, the states that are more landlord friendly. But how did you like put together that process? How did you get that boots on the ground team? Because let's say you are, like you mentioned, you're in Oregon and you decide, hey, I want to go out and I want to invest in Ohio, maybe Cleveland, Ohio, maybe the suburbs of Cleveland, maybe Toledo, Akron, wherever. How did you build that process out, and how did you like get that team ready to go to one find the properties, and then two to build the property management team? Because I would imagine you weren't going to be managing it yourself all the way across the coast.
Yeah, I mean, it was a lot of mistakes and tenacity, right? But actually, our first forte into investing out of state was actually turnkey, and it wasn't a good experience. I think many people, when they look to invest out of state, they learn about the concept of turnkey, and this is a buzzword out there. And as we were talking before the show, there's been some turnkey operators out there, like any business, especially in real estate, that maybe didn't have good experiences for people. And we were one of those. We bought Southside Chicago house duplexes, called them flats, like two flats and three flats. Basically, they were tiered multifamily, and they were in D or possibly F class type of locations. Great renovation by the provider, but just really bad experience on the management side. We lost money on all of those and ended up liquidating them. But that was our first experience investing out of state, and it wasn't good. And so from that, we decided that, hey, we like the idea of making the US our landscape and identifying markets where we get better returns, and to diversify and scale a portfolio quicker. But we need to build our own teams from the ground up, right? Like we need to do this. And it was a lot of trial and error, just like with anything. So finding, I mean, we have a systematic approach now that we've built for many years. But in the very beginning, it was difficult because you don't know a market. You don't know which market to identify. There's a lot of different markets to look at. And then it's like, how do you build the team in those areas? And you need key people, right? You need a key broker to help you find the deals. You need key property management. You need a lender that's going to actually be able to finance in those areas, right? Insurance. These are all things that we just basically had to piece together slowly over time, networking with the right people, asking for referrals. At the end of the day, Trevor, is just trial and error, right? Like finding a good contractor in these areas. Certainly, we did research and got recommendations from people and local brokers and real estate groups. But at the end of the day, we just had to try them out, right? And and the same thing for property management, where you sometimes have to go through 10 or 20 bad ones to find a good one, and then you really partner with the good one. Now our process when we open up a new market is much more streamlined. Like we have a whole thorough vetting process. Our company obviously has the reputation and the ability to go out and leverage current existing relationships. And sometimes we've even created teams from the ground up, or we've been able to partner with a local management team to expand on their current operations and add best practices from what we've seen in other markets. So it's been a long journey, but certainly we have some scars from our first forte into investing out of state.
Yeah, I definitely feel that. Even just going out there and trying to build a company, you could hire like folks that you think are going to be phenomenal, and then they just don't turn out to be that way. Even like my company, I've gotten good recommendations for employees. And you hire them, and it doesn't work out for whatever reason. Like you mentioned, it's a lot of trial and error. It's a lot of pain points to get to that point. But I like what you mentioned about Turnkey. It's been thrown around the industry a little bit, and I think where I'm getting at with this is trying to think like how turnkey is the operation. What I mean by that is, let's say I'm a passive investor like I am, and I'm investing in a couple of deals. I still got to be active to a degree where I still got to like vet the deals. I got to look at the deals, make sure it makes sense for, if I'm a cash flow investor and it's a pure equity play, appreciation play, then that deal's not going to make sense for me. But when it comes to the turnkey aspect of it, for your investors, when you're like talking to them, is it, are you going through like what they're looking to invest in, the different markets that they want to go through, or is it like, hey, we have these properties, let us know what you think? And then, so I guess that's the first question. And then the second one would be from the turnkey aspect of it, would it be like, hey, we're going to cover, our property management teams in place, anything under $500 in expense, we're going to go out and do it. Let's say the tenant calls and we have to fix a light bulb, or we have to, just simple things like that. Or now we need to replace the stove or the dishwasher, whatever it may be. Obviously, that's going to be a bigger expense, so we're going to have to get in contact with you to get your approval on that expense. Just curious what it looks like, what someone could expect, when talking to your company and then when working with your company.
Certainly. And so we definitely have procedures in place on, management. Like you mentioned in your second question in your example, like expense thresholds and things like this. But just backing up for a sec, and then we'll walk through the client journey to, I think, answer both questions thoroughly. But this whole concept of passive income is interesting. People love the idea, and myself included, of having an asset that works for you, which real estate can be. But I really think there's no such thing as true passive income out there, because you always need to be managing your money, right? Whether you're investing in a syndication deal where you're actually turning over control and money to someone, hopefully they are managing the project appropriately. You still need to vet them appropriately on the front end. You do need to make sure that albeit you have limited control, you still need to make sure they're performing well, right? And doing their accounting accurately. And you also need to make sure that you're setting up your own financial situation, both legally and just the structure and strategy financially internally. So you always need to be conscious and manage your money to some degree. Now, in the turnkey space, you are still physically owning rental real estate, right? You are 100% the owner. And so you're the one taking the risk, owning the real estate. You're the one taking the financing. You're the owner of the property. And even though we have management in place for each one of these properties, like sometimes you have to manage your property manager. A lot of that is just coaching and educating people on how to do that appropriately, even if we have all the systems set up in place. But this is still very much property ownership. And I do think that is, if that's something you want to do, actually own physical properties. I think this is definitely on the more passive end of the spectrum because you're not managing the properties. We have a very systematic approach to help you identify which markets and properties meet your goals. We have our fundamental criteria, right? We want to be, to your earlier point about New York, we want to be in areas that have landlord-friendly legislation, low taxes, future population, economic growth. So we're in the path of progress for appreciation in rents and home prices. We want to be in areas that have a diversity of industries. There's a deficit of 7.2 million houses in the US. We want to be in areas where we have an undersupply of housing. So all these things are important to be conscious about where to invest. But the client journey essentially is, if you're interested in investing out of state or owning rental real estate, expanding your portfolio, whatever the case is, you're thinking about Turnkey, the first thing we want to do is have a consultation with you to learn about like your goals and your strategy. Because one person may be more focused on equity growth, as you mentioned, and appreciation. We still have our fundamentals for cash flow that every deal should adhere to, but there's certainly different markets that might be better suited for the investor based on their goals, criteria, timeline, resources available, and then we want to work through a strategy to make sure that you're maximizing your tax benefits. Right? There's different creative financing options available that may help to expedite your goals. So it's much more beyond just buying a marketplace to buy turnkey and properties. It's about the team you're working with to build out that strategy and help to expedite your ultimate goals. But the first thing we do is jump on a consultation with you. We don't charge investors anything. We make our money through building and selling houses. We want to make sure that we spend ample time with you, understand what you're trying to accomplish, and then we look at kind of the high level structure. What type of financing makes the most sense? What lenders are you in touch with? Which markets make the most sense for you based on price points, based on your goals? And how are we structuring the tax strategy to allow you to scale quicker, right? Because we all run out of money, and down payments are like, capital is the most limiting factor. So if you can be a creative investor where, maybe you're using one of these loans we have where you put 5% down or possibly no money down to get into a deal, and you're maximizing the tax benefits of that might help to expedite your goals, invest in a retirement vehicle, something like that. So hopefully I answered your questions. It's a little bit all over the place. I think on the how turnkey this is, and how passive it can be, it's very involved in the front end. You need to, and I think you should be involved, right? You need to understand what your goals and your strategy are. You need to apply for a loan. You need to identify the property, go through the transaction. This is a normal closing process, appraisals, inspection, etc. But the idea is that once you have a plan, you execute that plan, you buy the properties, you're set up with management, assuming management's doing their job, which they should be doing, you should receive passive income on a monthly basis. But it is a good idea to check in with your management, especially in those first 90 days. Build good rapport, build good expectations, understand what their process is, and then focus on the bigger picture things, which is how you scale to accomplish your goals.
Yeah, I think there's just so much there. I want to dive in. And I think the one area where I want to go right now is, as you mentioned, I know we talked about it a little bit before, but you have your equity play and you have your more of your cash flow play. And touching back to your story, in my mind, I'm just thinking theoretically, just make it simple, 25,000. Let's say someone invested, in a cheaper home. Let's say the home was 125,000. They're maybe going more your Midwest, maybe more of your C-class property. 25,000. Let's say they got an 8% return. Make it easy, $200 a month, whatever the numbers may come out. When it came to you working through and going through and realizing hey, I can actually have the option to choose early retirement from investing in these properties, how did you sort of build your strategy? Was it hey, if I go out and buy 15 to 20 of these properties, cash flow and $200 each, I know I'm going to have the pay down over time. Maybe I put 15-year mortgages on them instead of 30 years. Those numbers work for me. Or I just keep them at 30 years and I know within 30 years I'm going to have all those properties paid off and get that additional cash flow. Curious how you worked your strategy out, from the turnkey's perspective to helping you achieve that early retirement.
It's been an evolution over time, and evolution about how we think about money, how we think about just investing in general, what types of properties we invest in, and where we're personally at financially. And I think a lot of people go through this same thought process early on in investing. The thing that most investors are conscious of is cash flow, especially if they have this idea of early retirement or financial independence or whatever the case is. You can kind of reverse engineer, to your point, reverse engineer how many properties you need to reach X amount of dollars. The most common number we hear from people is $10,000 a month, probably just because that's a round number, right? So, and the beautiful thing with cash flow at $10,000 a month with rental properties is, especially if you have leverage on those, that's probably tax free, which would be the equivalent of $17,000 a month or whatever of earned income. But essentially, the first goal of like financial independence, a lot of people look to achieve is just covering their expenses, $5,000 a month, whatever that is, and it's just buying properties. And that was very much where we started as well. It's just let's buy as many properties. And I've been investing for about 15 years now, Trevor, and I've never taken a year off. There's never been one year that I haven't bought in properties, regardless of interest rates, market cycle, COVID, whatever the case is, because we've always invested for fundamentals, and we know that real estate will perform over the long term, right? Things compound. And it's a cool point when you get to where you're buying properties, either through reinvesting your cash flow or 1031 exchanging. But the first point we got to was, okay, we covered our expenses. Great, but like we want to do more. And we were becoming more savvy investors. We started investing out of state. And we were always looking at cash flow. I think early on, it was always like, how do we maximize the cash flow on the properties? As we owned real estate over time, we began to see that actually wealth is built more so in being in growth areas. For example, I was stationed in North Dakota in the Air Force, and that's where we bought some of our first properties. We can cash flow well in North Dakota, but it's not a real appreciating market, at least in the areas we were at. And so we invested more in the Southeast, specifically new construction, where after 2 to 4 years, I mean, those houses, some of them doubled, but they appreciated extremely well, where it's like, hey, all of a sudden we can take out an equity line of credit, we can do cash out refinance, we can sell in 1031 exchange those and just like double our portfolio without having to inject more capital. And so the light bulb went off where it's like, maybe we need to be a little bit more conscious of growth areas. And this is the direction we personally went in our investing and what we try to be very conscious of with our business model as well. And that allowed us to replace our active income as doctors. And within it didn't take a lifetime, it didn't happen overnight, but within a relatively short period of time of intentional investing, we were able to do that through scaling our portfolio. Now at the point where we're at, I mean, we own a large 8-figure portfolio personally that cash flows over 7 figures annually net. And the biggest conscious thing that we focus on is tax benefits, right? Every property we buy, we run accelerated depreciation on. We look at doing 1031 exchanges on all of those to pass those deferred taxes forward. We do things like deferred sales trusts and just a lot of different creative tax strategies because we know time value of money. If we can defer taxes, that's more money we have today that then we can reinvest and actually earn an income on versus giving it to Uncle Sam. It's timely that we're having this podcast on tax week, but that's our main strategy now is focusing on appreciating. This is just personally appreciating areas where we can maximize tax benefits, roll that money forward, and just continue to grow that way. So it's been an evolution over time as our net worth has grown and the more savvy investors that we've become.
Yeah, that's a super smart strategy. Thinking of those areas where, like in my area, I know I could cash flow, but if I buy a property for 300,000, maybe in 10 years it might be 320,000, 325,000. But it hits that 1% rule, but it's not gonna really appreciate. Where my family in Massachusetts, like my dad, I think he bought his house 5 to 7 years ago now for 365,000. Now it's worth like 650,000, and he basically only redid the kitchen, but it's just because the area and where they live is just exploding with growth opportunities. So he gets that ton of that appreciation on that aspect of it. But I want to dive into a little bit further into the tax benefits and just get some clarification for our audience, because that's probably the number one reason I really enjoy investing in real estate. I think last year, all the income I made from my passive investments, every one of them, they went through, they had the cost segregation study, the depreciation came on. So even like ones that I was making like $200 a month on, I get my tax return shows a net loss of like $100. Even though I made $2,400, I'm able to take that money on that particular investment and save it to reinvest into my next deal. I wish I had that real estate professional tax status so I could claim, deduct that extra $100, but neither here nor there. But yeah, I'd love for you just to go into like how you've been able to use like that depreciation benefit. And like you mentioned, that accelerated depreciation to really offset some of your taxes. Because I think so many people get upset, and whether you like him or hate him, but you could think of like Donald Trump and folks, with him, like he just uses this depreciation on his property. So it really lowers his income. And then obviously he has the real estate professional tax status. So people get upset because he's not paying that much in taxes, but it's just written in the tax code. I could use it. You could, obviously you're using it. So, but for our audience out there, I'd love you just to go a little bit further into how you've been able to benefit from using some of the different tax strategies, to really offset some of these taxes or just push them down the road, or you mentioned like that 1031 exchange where you just keep putting it off and hopefully never have to pay taxes on those particular properties. Just how investing in real estate has really benefited you from a tax wise, because you could think a lot of our audience is those high income professionals, so folks that are earning 200K plus a year. Obviously in a W2, they're just getting hammered with taxes. Obviously if they get a bonus, they're getting crushed with taxes there. They might get a 50K bonus and they get 15K, 20K after it because Uncle Sam dips his pocket into it. So yeah, just curious from the tax benefits and how you've really been able to benefit from it.
Certainly. And if anyone listens to me ever on podcasts or our YouTube channel or whatever, like this is the point that I'm extremely passionate about, because I feel like it makes the biggest impact on your financial scenario. Real estate offers more tax benefits than any other asset class. And this is what the wealthy people are doing, right? They're using leverage. They're buying assets. Think about this for a big picture, and then I'll answer your question. But real estate, it's an asset where you can borrow someone's money, i.e. the bank or a private lender. You can buy an asset that you have 100% control, ownership, and receive 100% of the benefits from income and taxes from, that someone else pays off the loan for you, i.e. the tenant, right? So this is what the wealthy do. They use other people's money, they acquire assets, and then they maximize their tax benefits, and they reinvest their interest, they reinvest the equity, and they continue to grow and amass these large portfolios. And when you look at it from that perspective, like, most people that are building mass wealth in real estate, yes, cash flow is a good byproduct to cover the investment, but they are more focused on the growth versus the actual cash flow. But these are some of the strategies that we've employed in our personal lives, and we help investors work with on an individual basis. So I'll talk about my scenario, but I also want to talk about from some of our, use some examples from some of our investors. So one of the biggest things, the benefits right now is, since we're talking about, is cost segregation, right? This is basically where you can accelerate a portion of the depreciation to take in year one. And anyone can do this. If you are, the big benefit though, where it makes a big impact, is if you can qualify as a real estate professional, which there's hours associated with this. And, there's things, I mean, if you're a full-time employed person and you're a beginning new real estate investor, maybe you can qualify for it, but maybe you have a spouse that works part-time or doesn't work, then they could qualify for that. And you combine that when you file your taxes and still get those benefits. I mean, these are all strategically things we work with individual clients, but that's one of the biggest and most impactful things you can do is accelerate depreciation. And where that becomes powerful is where you can take this passive loss and offset against your active income, to your W-2 job, or all sources of income. It just lowers your tax basis. So if you buy $1 million property, our cost segregation studies, which are an engineer report showing all the things, a 5 and 15-year life on the property that can be accelerated into year one, and depreciated that year, they usually come in between 30 to 35%. We've had some come in on commercial assets over 40%, but we usually use 30% as a general calculation. And this would be at 100% bonus depreciation, which may come back into play here. We'll see. But $1 million property, $300,000 of accelerated depreciation. That means you still have, and not talking about removing land just for simplistic purposes, you have $700,000 that are still normal depreciation you take over the next 27 and a half years, or 39 in commercial. And that $300,000 you offset on your income from day one, right? This year. So that could save you, depending on your tax bracket, hundreds of thousands of dollars of actual taxes that you would otherwise pay to then reinvest, earn income on, earn interest on, and then buy more properties to run accelerated depreciation. That has been the biggest play that many people have used, while we've had benefit from that from the 2017 Tax Act. And likely that will come back to bonus depreciation, hopefully here soon, as that bill is currently sitting in the Senate. But there's many other tax benefits. Well, before I move on from cost seg, I mean, just being conscious and working with a good real estate savvy CPA is so vitally important. That way, so many people don't fully understand all the tax benefits. They understand, like, oh, you get a write-off mortgage interest, you get normal depreciation. Like, great, my cash flow is, like, to your example, your cash flow is offset by just normal tax benefits and depreciation. It's tax-free cash flow, right? However, there's a lot of other things. For example, and don't quote me exactly on this, I'm not a CPA, but if you earn $150,000 or less, and I believe this is combined, but if you're in this income bracket or below it, anyone can take passive losses against active income up to, I believe it's $28,000. So, I mean, if you earn $100K a year, you might want to do a cost seg to get $28,000. Just, that's a huge tax benefits, right? That's more than you can put into an IRA, HSA, whatever the case. So that's something to be conscious of. Also, one creative thing we work with investors that aren't real estate professionals, Trevor, is that there's a short-term loophole here. And I just want to say this first. All the things we're talking about, This isn't sneaky stuff. This isn't a gray area with the IRS. This is stuff the IRS encourages us to do as real estate investors to stimulate the economy, right? We're incentivized because we're creating jobs, we're creating housing for people, we're stimulating the economy to do these things and are encouraged to do this stuff. So this isn't about not like just trying to evade taxes or not sneaky ways not to pay taxes. This is what the IRS wants us to do. But there is a way where, hey, if you're not a real estate professional, let's say you and your spouse are both employed full time, and you still you have a high income and you're paying high taxes, and you want to use accelerated depreciation, you can buy a short-term rental property and self-manage it for the first year, because that's the year you put it into service. So we have a lot of new construction properties that people will, and we teach you how to do that. We teach you how to furnish it, how to self-manage it from a distance. Very easy to do, even though it may seem daunting. You can still run accelerated depreciation on and take that against your active income without RE Pro, even if this is the first property you buy. And then the next year, you can decide if you want to continue to self-manage it, which a lot of our investors do because they find out it's not that difficult, or they can, turn it over to management, because after you do the cost tag, it doesn't matter. So that's one of many things. 1031 exchange is also a huge thing, because depreciation is recapturable. When you sell property, you have to pay capital gains on it, which could be a huge chunk of your equity that you build. However, you can roll that forward. And, we kind of use the term swap till you drop. And you alluded to this earlier. You can do 1031 exchanges forever. And then you pass it on to your kids. They get a step up basis, and that depreciation is never recaptured. That's another thing that we work with people on. We also have creative financing options. We had a investor of ours that basically, he was paying six figures in taxes every single year, and it was painful. And he had about, I think it was 150, 120, 150 to invest that year. And we showed him how he could use creative financing options to buy some investment properties, where he got into those with, actually, it was very little down. We have credit unions that will do 5% down loans on up to 5 investment properties. These are not primary residencies. They're true investment properties. It's a portfolio loan where you can buy multiple properties with 5% down. Well, we have a program where we will actually pay the 5% down on select inventory. He still had some closing costs and things like that, but he was able to buy a ton of properties with little to no money down, and he invested a portion of that 150K that he had to buy more properties, where he was able to wipe out his entire tax liability for that year, saving hundreds of thousands of dollars that now he gets to reinvest by using some of these creative financing properties. These are all new construction properties in the Southeast that are growth areas. They have positive cash flow, but then, they'll also be positioned for strong appreciation, which he'll get to tap into in the future as well. So, there's just so many things. We could talk all day on this, but there's so many different creative strategies that you can use to reduce your tax liability, because taxes are the biggest expense we're all going to pay in our lives, right? And that is the easiest way to give yourself an immediate raise. And if you understand the time value of money, once you give money to Uncle Sam, it's gone. But if you can actually save that, whether it's not paying taxes at all or deferring those taxes even a few years, to actually go out and make other investments and earn income and buy another property that's, again, appreciating, that's cash flowing, that it has another depreciation schedule you can use. This stuff just snowballs and compounds. And so we learned that early on, where it's like, man, the more that all these strategies we can combine to actually own more rental real estate, you can amass a large portfolio in a relatively short period of time. Just let real estate do what it does over time, and build significant wealth. So I know I went off on a few tangents there, but hopefully I answered your question.
Yeah, that was perfect. And I was thinking through the creative financing aspect of it. And with that, so let's say someone comes in, like you mentioned, that doctor, they're financing, say, 95% LTV. How does it work? Or how does the deal make sense? Is it because it's BTR? I'm just thinking, like, when I'm looking at like commercial property, so you're looking at 100-unit multifamily. You usually got to be at least 80% LTV. Usually you want to be, at least right now, maybe 60-70% LTV, just given the market conditions. Just curious how the numbers are able to work, even if someone is doing like a 95% LTV on a type of deal. Is it because it is BTR, or is it because these deals that you're sourcing out are just very good because you've been in the space for a long time?
Well, it all depends on, and that was just one of many examples that we have available to our clients to help them accomplish their goals, whatever those goals are, because they're very individualistic for each person. But on that specific example, so there are credit unions in specific geographic locations. This is not nationwide. These are not Fannie Mae, Freddie Mac loans. These are portfolio lenders that offer a 95% loan to value on select new construction single family residencies in select areas. And mainly these are Southeast new construction properties. And so what they'll do, it's a 10-year term, it's a 30-year AM, and you still have to qualify for this, right? So you need to have 720 credit minimum to at least get the full 95%. And you don't have to do only 5% down. You could do 7%, 8% down, whatever the case is. In most of those cases, Trevor, you can imagine they're probably not going to be positive cash flow or significant positive cash flow if you have a 95% loan on the property. Someone that is doing that isn't necessarily worried about cash flow. They're worried, they want to maximize their capital and buy as much real estate as they possibly can and maximize their tax benefits. But again, if you're buying 95% LTV and the property is negative $200 a month cash flow, maybe it makes sense to put 8% down and have break even or slightly positive cash flow. It's all deal dependent, but at least you can stretch your capital further. And as I alluded to earlier, we have some programs where we will actually pay the 5% down. So someone could come into, a no money down type deal, or they have a few closing costs. And alternatively, if someone had different goals where they wanted to maximize cash flow, I mean, we could take that same 5% that we were going to pay for their down payment, and we just reduce the purchase price. So on a $400,000 property, they get $20,000 of immediate equity. Maybe that makes more sense for someone in that scenario. And then they are cash flowing. They're still putting the down payment down, but they come into immediate equity where they can do cash out refi sooner. Or maybe it makes sense to buy the interest rate down. We also have loans right now where 5% can be applied to buy the interest rate down to 3.99%. And then all of a sudden their property, and that's a 10-year ARM, so it's a fixed interest rate at 3.99% for 10 years, which is a really good ARM, by the way. But that property is going to cash flow significantly more than if you had your current 7% or whatever it is on that. So my point is that it's very deal dependent, but there's many ways to skin the cat with the same deal, right? Depending on your goals. If you want to maximize cash flow, great, let's focus on that. If you want to come into immediate equity, let's look at that. If you want to, stretch your capital as far as you can to own as much as you can and maximize tax benefits, then that's the strategy we're going to focus on with you. It all depends on what position you're in, what you want to accomplish, what your timeline is.
Yeah, I think that's perfect going back to the strategy aspect of it. Because again, I know we've talked about it before, but some folks, maybe they just want to do more pure cash flow play. Maybe some folks want more of the tax strategy play. Some folks maybe want equity play. And I think for those listening, like, you really got to figure out what do you want to do on your own. I think that was like a big learning curve for me, is I was like, oh, I want to invest in this asset class. I want to invest in this property. Then all of a sudden I'm in a couple cash flow deals. I'm in a couple equity deals. And now I'm like, I kind of wish I was all in cash flow. And it comes with learning experience, anything like that. But you really got to ask yourself, what point I found for me was like, what point or what do I want to achieve in my life? And for me, it was like, I want to achieve financial freedom. I want to have the cash flow coming in to just cover my monthly expenses and give me the choice. Hey, if I want to keep running my business, I can, or if I want to do something else, I also have that option too, where the equity play could get me there, but there's not going to be that immediate cash flow play, but I could get a higher return on the equity play just because there's more risk, but then there's going to be more reward. So you just got to think through everything and the different strategies, like Zach mentioned out there. Everything out there, it sounds like his company is going to be deal by deal specific. It's going to be specific to the individual and what you're looking to achieve. So I think that was great, really great going over that. But I'm curious, how's it been in like the BTR space and going out there in the new construction space? I know I'm not so much now, but I know early on in the pandemic, it was like the cost of lumber was like, through the roof. I think it's come back down to earth now, but just curious how that transition has been, more so from the properties maybe you were going out there and buying early on, where again, let's just say they were in the Midwest, they're already built, maybe they're built 70s, 80s, whatnot. And then now you're going out and, building out these new houses. How's that sort of process been for your company, moving from, one sort of area into this other, area within real estate?
Certainly. When you think about, if anyone's heard of Turnkey before or explored this, or maybe even invested in Turnkey, kind of the traditional, I guess, thought on Turnkey, or where most Turnkey operators are focusing, is exactly that: the Midwestern property that's 120,000, 150,000. It's 1960s, 70s house that's been renovated, and that's a good bread and butter rental property. It's low capital to come in and buy that, and it can provide good cash flow. It's probably not going to be in a market that's appreciating dramatically over time, and you will have maybe lower quality tenants as well as more maintenance with that property. That's where our company started, focusing on those, and we still do have those opportunities for people that are looking for a lower barrier of entry to buy properties and want to maximize cash flow. But about 70% of what we do is build to rent new construction, single family and small multifamily, mainly in the Southeast where there's growth markets. And just over time, I've kind of come to realize that new construction will perform better over time, not only with reduced maintenance. You're in better class areas, attract better quality tenants. They are more expensive, so it requires more money down. Our average, Midwestern property, 120, 150,000 for your, 3-4 bedroom workforce housing. In the Southeast, you're probably 250 to 300,000 for that same single family, but it's a brand new built house in an A-class area, quality tenants that stay longer, they perform better. There's more consistency with that, more predictability. That's what we like. But the big benefit is over time. New construction in growth areas, you're going to have, even though the cash flow may be less, like if you're comparing a Midwestern deal to a brand new construction, the new construction is more expensive. That rent to price ratio is probably a little bit lower, so the cash flow may not look as attractive. You may have a 6% cash on cash return, whereas you may have a 9 or 10% in the Midwest, right? So on the surface, pro forma day one, that lower price property may look better, but over time, the built to rent and the new construction will perform better. They'll have better appreciation in home prices, better appreciation in rents. I mean, a lot of the markets, even over the past 2 years, which has been kind of a stagnant market or a little volatile market in a lot of places of the country. I mean, the areas that we focus on in Florida, Texas, Alabama, Carolinas, I mean, these are areas where we're still seeing double-digit appreciation both in rents and home prices over time, just because it's supply and demand. These are areas where the population is moving. There's an undersupply of housing, and there's demand to keep the houses rented and buyers as well. So, I mean, the common strategy would be someone that buys a property through a network, they hold on to it for 4 to 5 years, they let it appreciate, the tenant pays the loan down a little bit, they have enough equity where they can 1031 exchange it and buy 2 or 3 other properties just by letting real estate do what it does. So it also helps them with their trajectory over time scale up quicker. So we like new construction for all those reasons. And man, it is just less tenant issues. It's less noise. But the construction market has been crazy. It's been tough, right? I mean, financing has been tough, especially as, maybe we had some construction loans that were at 3% that are now at 5 or 7%, or some other loans that are up at 11% construction. So it's like, the construction market, labor is limited, materials, we still see some lingering things from COVID. So it's been a tough market, but I think what served us well, and why I like working with investors, what's allowed us to stay in business while a lot of builders struggled in this industry over the past 3 to 5 years, is the simple fact that we have consistent flow of business. We work with investors where they are consistently, instead of the retail market where someone's buying one house every 7 years, most of our investors are buying multiple properties, both year one and year after year, to scale their portfolio. And we focus on the real estate fundamentals. We want to be in growth areas, we want to be below the median house price point, which is, give or take $400,000 across the US. We try to be well below that, so we have the highest pool for buyers, tenants, et cetera, and be in areas where, we can still do well, even with fluctuating construction prices and all the stuff we all have to deal with.
Yeah, and I really like that aspect of going in the new build. And like you mentioned, for me, it almost seems like there's going to be less headaches, because you would think if you're going along the lines more Class A than your Class C property, where Class C, it's gonna look better. The price point maybe is 125, 150,000, where the Class A, new build, I mean, maybe not even Class A, but just a very high end Class B, great neighborhood. Maybe you're looking at 350, 400,000, and you look, if I put 20% down on this, I might cash flow the same as I do on this $150,000 property. But at the same point, there's a lot less you have to deal with. There's a lot less maintenance, there's a lot less repairs, and then just overall probably the tenant base. Usually the folks I would imagine that moving to these single family homes or the built to rent space, maybe they do have a family, they have good jobs, they have an overall higher income. And I think there's studies out there where it's simple, folks that own a house typically earn way more in their lifetime than those folks that just rent their entire lifetime. So I find that typically you would hope the folks that make more money are going to take better care of the property. And then, they have the nice single family home. The property's nice. They want to keep it that way. Not to say that every tenant would be like that, but hopefully the majority of them are. Hopefully everyone's respectful of the property that they're living in, whether they're renting it or whether it's an apartment complex, or whether it's just, it's a single family home that they are going out there and renting out. But
well, if you have a tenant that's paying $2,500 a month in a new construction $300,000 house, that is a higher tenant demographic than someone that's paying $1,200 a month.
Mhm.
Now granted, There could be difference in wages across the country in different parts and cost of living and things like that. But generally speaking, as you charge more for rent, you do get better quality tenants. But to your earlier point, Trevor, my advice to everyone when you're evaluating real estate, whether you're looking at turnkey or otherwise, don't fall into the trap of only looking at a pro forma that is year one analysis, right?
Mm.
A year one analysis is a snapshot in year one. And on our website, we actually have the wealth tracker. It's a free calculator that you can track your portfolio performance, not just one property, but multiple properties. But most importantly, you can forward project. You can look at whatever variables you want to punch in for appreciation and rent growth and amortization. You can look forward thinking and say 5-10 years, if I buy X amount of properties, like this is where I'm going to be both cash flow and net worth wise. But I think that's really a big thing that we learned over time, is that we early on, we just focused on cash flow, year one projections, but you really need to understand how real estate works for you over time. Rents go up over time. So even though your cash on cash may be 5-6% today, your mortgage doesn't change next year.
Mhm.
Next year, now expenses would potentially less on new construction, but your rent's going up. Our average rent increase every year is 6%. That's double the national average. That's because we're in demand areas. And so being forward thinking about where is this property going to be in 5 or 10 years, both from an equity standpoint as well as cash flow, like that's really important. And I think that will help you reverse engineer your buying decisions now based on your goals.
Yeah, I think that's awesome. Really looking at like the long term picture instead of just coming in and thinking like, okay, yeah, it's gonna cash flow more. Maybe cash flow is $250 instead of $150, and year one. So I think that's great that you explained that. But Zach, I just want to say I really enjoyed our interview today. And for our audience out there, where can they learn more about your company if they are interested and invested? Can they book a consultation call with your team? How does that look, and where should they go to?
Absolutely. I drive everyone to our website. That's renttoretirement.com, renttoretirement.com. We have a lot of resources on there. We have our own podcast and YouTube channel. We put out a lot of information outside of just turnkey investing, right? Market data, tools and resources, lending options. Our goal is to add value to every single person that we come in contact with. Again, we don't charge investors anything. We make our money through building and selling houses. And our goal is to ensure that our investors meet their expectations and have a good experience, so they come back to invest. So, and if you're listening to this in the car, you can text REI to 33777. But yeah, we'd be happy to connect with you and have a consultation, see how we can add value to your investing strategy, regardless if you're looking at turnkey or not. But be happy to discuss some of the creative financing options, build to rent, market data that we have. We're very passionate about real estate. So
Awesome. I'll make sure to include that in today's or the episode show notes. And Zach, again, thank you so much for coming on to the show.
thanks so much, Trevor.